Welcome to the Finca Lab. Today, we are analyzing a seismic shift in the global financial bedrock. We call it the De-Dollarization Surge. For decades, the US dollar was the undisputed king of reserves. But the data for 2026 is showing a deviation we haven't seen since the late 90s. Central banks are buying gold at a historic pace. They aren't just nibbling at the edges. They are devouring supply to diversify their vaults. The leaders of this movement, China, India, and Turkey. These nations are aggressively swapping fiat currency, exposure for hard assets. And here is the critical data point. For the first time in decades, gold now accounts for a larger share of global central bank reserves than US Treasuries. This isn't a coincidence. In the lab, we look for cause and effect. Why are they ditching the dollar? It comes down to trust and control. Wall Street is reacting. Goldman Sachs is forecasting gold to hit $5,400 by year-end. That is a massive repricing. Bank of America is even more aggressive, suggesting a bull case scenario of $6,000. But let's pause the hype and look at the mechanics. To understand this surge, we must understand counterparty risk. When you hold dollars, you hold a promise from the US government. When you hold gold, you hold a physical asset. It has no counterparty. It requires no promise from a government to retain its value. Central banks are risk-averse. They see geopolitical friction and inflation as threats to their paper assets. They are seeking a shield. This is what we call de-dollarization. It is not that the dollar will vanish tomorrow, but its dominance is being diluted, percentage by percentage. However, a price target of $6,000 implies volatility. In the lab, we know that markets rarely move in a straight line. Expect turbulence. If gold is to triple or quadruple, there will be massive corrections along the way. That is the nature of a bull market. Why 2026? The timeline suggests a convergence of sovereign debt maturity and shifting trade alliances. The clock is ticking. We must also discuss the weaponization of finance. Sanctions have taught nations that if you disagree with the issuer, your reserves can be frozen. You cannot freeze a bar of gold sitting in a vault in Shanghai or Mumbai. This is about sovereignty as much as it is about profit. Interestingly, the general public isn't buying gold at this rate yet. This is an institutional shift. The big money is moving first. So, we have the problem. The dollar is losing favor. We have the data. Buying is at record highs. Now, let's break down the mechanics in the next section. We are going to calculate the actual impact on the global economy and what this means for the average investor. Let's place the supply side under the microscope. Price is not just about who is buying. It is about how much is available to be bought. Global gold mining output has effectively plateaued. We are not discovering massive new veins. The supply is inelastic, cannot react quickly to price spikes. Contrast this with fiat currency. A central bank can print billions in a keystroke. A gold miner needs a decade to bring a new mine online. When central banks become the primary buyer, they create what we call a price floor. They are the whales that swallow the dips. This acts like a put option for the market. Investors know that if the price drops, sovereign nations are waiting to step in and accumulate. Now, observe this anomaly. Historically, when real interest rates go up, gold goes down. It yields nothing, so high rates usually hurt it. But look at the data now. Rates are high, yet gold is rallying. The correlation has broken. This is a massive signal of a regime change. Why the decoupling? Because the utility of gold has shifted from inflation hedge to geopolitical safety. Fear is a stronger driver than yield. We must also analyze the BRICS bloc. They are actively building payment rails that bypass the SWIFT system, often using gold as the neutral collateral. The petrodollar agreement is eroding. Oil is increasingly being sold in yuan or rupees, which are then often converted back into bullion. This circular trade loop reduces the velocity of the dollar. Fewer dollars needed for trade means fewer dollars held in reserves simultaneously. The supply of US debt is exploding. Central banks are asking, who will buy all these treasuries if we stop? Fiscal dominance is the concern. When deficits run this hot, the market anticipates that the currency must eventually be debased to pay the debt. It is simple math. If the denominator, the currency, loses quality, the numerator, the asset price, must rise to compensate. We also see a divergence. between paper, gold, futures, contracts, and physical gold. The premium for the real metal is rising. This indicates a scramble for possession. A contract is a promise. A bar is property. In low-trust environments, property wins. But be warned, as price discovery shifts to the physical market, liquidity can dry up. This leads to sharp, violent price gaps. For the average investor, this manifests as high premiums. You might see the spot price at X, but buying a coin costs X plus 10%. We have analyzed the supply constraints and the geopolitical demand. The structural forces are undeniable, but no analysis is complete without the bear case. What could derail this $6,000 forecast? Let's examine the risks. First risk, the dollar wrecking ball. If the U.S. economy accelerates and interest rates remain higher for longer, the dollar becomes a vacuum for global capital. Second risk, a liquidity crisis. In a true market crash, everything gets sold to raise cash. Gold is liquid, so it often gets sold first to cover margin calls. Third, risk institutional profit-taking. If a major holder like Turkey or China faces a domestic crisis, they may dump gold reserves to save their own currency. Fourth risk, geopolitical stabilization. If global conflicts resolve unexpectedly, the war premium baked into the price of gold evaporates instantly. Finally, the digital competitor. Bitcoin is increasingly vying for the role of store of value. Capital that used to flow to gold is now splitting its allegiance, a crucial distinction. Gold miners are not gold. Mining stocks have underperformed because their costs, energy, and labor have skyrocketed. Eating their margins. Do not confuse the asset with the company digging it up. One is a currency. The other is a business subject to inflation and operational failure. So, how do we navigate this in the lab? We remove emotion. We do not become gold bugs or dollar bulls. We become risk managers. We must reframe our thinking. Gold is not an investment that produces cash flow. It is an insurance policy against monetary failure. You do not buy fire insurance hoping your house burns down to get rich. You buy it so that if the house does burn, you are not ruined. This brings us to the framework. In the lab, we advocate for the 5 to 10% rule. Never 0, but rarely more than 10. Allocation matters. A 5% allocation stabilizes a portfolio during volatility. A 50% allocation drags down your long-term compounding growth. Next, the hierarchy of ownership. Not all gold is created equal. The closer you are to the physical metal, the lower your counterparty risk. Tier 1 is physical possession, coins or bars you can touch. If the digital financial system goes dark, this is the only tier that matters. Tier 2 involves ETFs and paper claims. Convenient for trading, yes. But in a systemic crisis, you are relying on a custodian to actually hold the metal. Be aware of the carry cost. Physical gold costs money to store and insure. ETFs charge management fees. Gold pays no dividends to offset this. The strategy for entry: dollar cost averaging. With volatility expected to increase, buying a lump sum at all-time highs is statistically dangerous. Instead, set a schedule. Buy small amounts, monthly. If the price crashes to $2,000, you accumulate more. If it rips to $3,000, your average stays healthy. And the most important rule: if gold hits that $6,000 target and becomes 20% of your portfolio, you must have the discipline to sell. We have the theory. Now, let's go deeper into the practicals. How do you actually buy without getting ripped off on premiums? Let's talk about the premium. The spot price you see on TV is for a 400-ounce bar in London. That is not the price you pay for a coin. Coins carry higher premiums due to fabrication costs and collectability. Bars are cheaper per ounce. If your goal is weight, ignore the pretty designs. By the bar, you must also understand the spread. You buy at retail and sell at wholesale. The moment you buy physical gold, you are effectively down 5%. Avoid numismatic or collector coins unless you are an expert. Salesmen push them for higher commissions. Stick to standard, recognized bullion. Counterfeits are real. Tungsten has the same density as gold. If buying privately, verify. A simple magnet test or a specific gravity test is mandatory. This leads to the logistics of bearer assets. If you lose it, it is gone. If it is stolen, it is gone. You are your own bank. Home storage is private but risky. Professional vaulting is secure but introduces a third party and monthly fees. There is no risk-free solution for significant wealth. Consider jurisdiction diversification. Storing gold in a vault in Singapore or Switzerland protects you from domestic confiscation or legal seizure. Do not forget the taxman. In many jurisdictions, gold is taxed as a collectible, meaning a higher capital gains rate than stocks. Privacy has limits. Large cash purchases or sales often trigger reporting requirements. Know the thresholds in your country before you transact. Now, let's zoom out. To see where we are going, we must look at the 1970s. The parallels are striking. Then, like now, we had high government spending, energy shocks, and a loss of faith in fiat currency. Gold rose 20-fold in that decade. But look at 2011. Gold hit a record. Everyone screamed hyperinflation, and then it crashed for 5 years. The narrative failed. The difference today? Sentiment. In 2011, gold was a mania. Today, despite record prices, the retail public is largely ignoring it. We call this the taxi driver indicator. When your driver gives you gold tips, the top is in. We are not there yet. This rally is driven by the whales, the central banks, retail investors. Usually chase the price after it has already doubled. That wave is yet to come. This creates a dangerous leverage in the futures market. There are hundreds of paper claims for every single ounce of physical gold in the COMEX vaults. If those paper HOLDERs stand for delivery demanding, the actual metal we could see a short squeeze that rips the price higher vertically. Time is the final variable. De-dollarization is not an event. It is a process. It happens slowly and then all at once. So, what does the future hold beyond 2026? Let's look at the endgame scenarios for the sovereign debt. Crisis. The endgame revolves around the debt trap. Developed nations have debts so high they cannot pay the interest if rates stay. Normal. This leads to yield curve control. Central banks are forced to print money to buy their own government's debt to keep interest rates artificially low. This is the rocket fuel for gold. If they suppress yields, they sacrifice the currency. Capital flees the devaluing cash and hides in hard assets. Governments face a binary choice: default on promises, political suicide, or inflate the debt away, the hidden tax. History shows they always choose inflation. Enter the CBDCs, central bank digital currency. This is the state's answer to losing control. A fully digital, programmable, trackable fiat currency. In a world of programmable money, gold becomes the last bastion of analog freedom. It cannot be turned off. It cannot be programmed to expire. If CBDCs introduce negative interest rates to stimulate spending, your digital cash shrinks. Gold, sitting in a vault, is immune to this policy code. Some theorists predict a formal revaluation to make the massive debt pile sustainable. Central banks could agree to reprice gold significantly higher at $20,000 an ounce. The gold on the central bank balance sheets would mathematically cover the outstanding fiat liabilities. It is a reset button. We have precedent. In 1933, the U.S. revalued gold from $20 to $35 overnight. Overnight, the dollar was devalued by 40%. These are extreme scenarios, yes. But in the lab, we prepare for the tails of the bell curve. The unthinkable happens once every few generations. It is easy to get caught up in doom porn. Fear sells. But remember, the world usually muddles through. Do not bet on the apocalypse. Your goal is wealth preservation, not just survival. You want to have purchasing power on the other side of the crisis to buy productive assets. That is the true function of gold. It is the liquidity you sell to buy stocks or real estate when they are cheap and blood is in the streets. Before we conclude, a warning against FOMO. When headlines scream $6,000 gold, the urge to go all in is powerful. Resist it. Investing from the amygdala of the fear center leads to buying tops and selling bottoms. Use the prefrontal cortex. Stick to the allocation math. Gold is a long game. It can go sideways for a decade. It tests your patience. It is boring. That is a feature, not a bug. We have covered the geopolitical shift, the supply crunch, the risks, and the execution. Now, let's synthesize this into a final action plan. The transition away from a dollar-centric world is the story of the next decade. You do not need to predict the exact path to prepare for the destination. Let's summarize the findings from the lab. Here are the 3 key takeaways you need to write down right now. Summary point 1. The whales are hungry. Central banks are buying gold to diversify away from the dollar. This is a structural long-term shift, not a short-term trade. They are prioritizing return of capital over return on capital. In a fragmenting world, the safety of a sovereign asset with no counterparty. Risk is paramount. Summary point 2. The fiscal trap. Western debt levels are mathematically unsustainable without currency. Gold is simply repricing to reflect the diluting purchasing power of paper money. Whether the target is $3,000 or $6,000, the trajectory is set by the printing press. The supply of fiat is infinite. The supply of gold is finite. Summary point 3. The Allocation Rule. Treat gold as insurance, not a lottery ticket. Maintain a 5 to 10% allocation to hedge against monetary accidents. Do not succumb to FOMO. Use dollar cost averaging to build your position. Focus on physical possession or trusted low-fee vehicles to minimize counterparty risk as we approach 2026. Watch the bond markets. If yields spike and the Fed intervenes with yield curve control, that is your signal that the next leg up has begun. De-Dollarization is a slow-moving glacier. But when it calves, it creates massive waves. Your job is to be in the boat, not swimming against the tide. I leave you with this question. If the bond market breaks tomorrow, what asset in your portfolio do you trust to hold its value? That concludes our analysis for today. We have tested the hypothesis and reviewed the data. Now, the execution is up to you. If you found value in this analysis, help the lab grow. Click the like button and subscribe to ensure you don't miss our next deep dive into the markets. I want to hear from you in the comments. Do you believe the $6,000 target is realistic, or is it just Wall Street hype? Let's debate the data. For those who want the charts and the raw data sources we used in this video, join our free newsletter. The link is in the description. In our next session, we might tackle the Bitcoin versus gold debate in detail. You won't want to miss that comparison. A reminder, this is education, not financial advice. I am a cartoon guru in a sketch lab. Consult a qualified advisor before making investment decisions. Markets are efficient, but they are also emotional. Stay rational, stay analytical, and keep testing your assumptions. Until next time, keep your risk managed and your horizon long.